Let's just face it, things haven't been great for retirement planning over the past year. I mean, we've had a market sell-off, we've had inflation at decade highs, and now we have a Fed who's aggressively trying to push the economy into either a slowdown or a recession with their monetary policy. It's been pretty hard, and it's not like there have been any positive stories out there aside from the big Social Security increase. Instead, we've gotten headline after headline talking about a retirement crisis or how things have gotten so much more difficult for people considering retirement to the point where now Congress is looking to step in. Now, I'm not saying that everything is rainbows and sunshine out there, but if you're planning for retirement over the next few years, then I will say one thing. I'm a lot more optimistic about retirement planning now than I was a year ago. And in this video, I'm going to share 3 reasons why I'm optimistic about the future of retirement planning. Hey everybody, I'm Johnathan Rankin, the founder and CEO of Theorem Wealth Management, and my firm and I have been helping clients plan and execute their retirement plans by focusing on 3 key areas: maximizing retirement income, optimizing investments, and reducing taxes. Now, if you're thinking about retirement or you're already retired, make sure you hit that subscribe button so you don't miss any of our retirement videos or episodes of our retirement podcast called The Retire Once Show. For over 15 years, I've been helping people achieve their retirement goals, and for 13 of those years, there was one thing that was very challenging about building investment portfolios for clients who were retired, which leads me to the first reason why I'm optimistic about the future of retirement. You can finally get some yield. Since 2009, the Fed has kept rates extremely low, and this was great for helping with things like mortgage rates and overall economic growth. But for people who are retired, it made things extremely difficult. Conventional wisdom says that the older you get and the closer to retirement you get, the more conservative your portfolio should become. And this is exactly what we see in things like target date funds within 401ks. They are designed to reduce the allocation of stocks and increase the allocation of bonds the closer you get to retirement. Now, this worked in the decades leading up to the 2008 global financial crisis, when the yield on the 10-year treasury was well above 4%, and in certain years even topped 9%. And then for almost 14 years, that yield never made it above 4% again. This made investing for retirement very challenging. Clients were faced with a decision to make. Do you accept a lower yield? Do you put your assets into an income product like an annuity and tie up your flexibility? Or do you take on more risk? There really wasn't the ability to achieve a low risk, higher yielding income that provided you asset flexibility. Everywhere you turned, there were headlines talking about the search for yield because at the time, the only way to get a higher rate of income was to take on additional risk or tie up your assets. I mean, here's a perfect example. Money.com had an article about how retirees can live off their savings in a low rate environment. And what are they suggesting? Dividend paying stocks. Now, this isn't me saying that dividend paying stocks are a bad idea, but I wouldn't place that investment into a low volatility, steady income category. If you're building out an asset allocation of stocks and bonds, the stretch for yield into things like dividend paying stocks or even junk bonds that come with a higher yield, it also comes with a higher increased risk. Now, when rates are higher, getting a low risk yield like you would in a treasury bond or a high quality corporate bond can help maintain more of a balanced portfolio over time. Now that we are seeing inflation subsiding, being able to reduce risk without sacrificing portfolio yield is a huge benefit for people who are planning on retirement. In fact, Morgan Stanley even put out a piece discussing how investors will look to bonds in 2023, citing how bond yields have meaningfully increased. They go on to discuss how now investors have an opportunity to earn a decent income, and while we still might be in store for further stock market volatility as this bear market plays out, and now you add on the possibility of an economic slowdown or recession, being able to get back to an asset allocation that provides income and long-term growth while reducing volatility makes me really optimistic about the future of retirement planning. And that brings me to the second reason why I'm optimistic about the future of retirement: the bear market in stocks. I know you might be thinking, Johnathan, my portfolio is down, stocks are down, it looks pretty grim out there. But if you have a few years until you retire, this gives you the opportunity to take advantage of the stock market. This really reminds me of when I bought my first house. It was in early 2010 in Phoenix, Arizona, after housing prices had already dropped tremendously and foreclosures were all over the place. Now, luckily, I was able to get a good deal on a house and prices eventually went back up. But there was one thing that was always on my mind as I lived in the house. I always wish I bought a different house. That's not because I didn't like the house I lived in. In fact, I really liked it. But nobody knew what prices were going to do over the coming years, and it turned out that they actually increased pretty significantly, and even more in certain parts of the city. So I always look back and I wish that I had bought a different house in a different part of the city because it would have increased so much more in value. That's how I view this bear market. I don't know when it's going to happen, but at some point in the future, the market's going to hit an all-time high. And after every correction that I've worked through, whether it was 2008, 2018, 2020, people always look back and wish they did more. And I know it's not easy. In fact, it's actually really scary in those moments because we don't know how long things are going to last. We don't know how deep the bear market's going to go, if it's going to go on for months or years. I mean, we don't know if we've even seen the bottom yet in this bear market or if there's more losses to come. So this isn't me saying that you should go out and start taking on a bunch of risk, but one thing you don't want to do is shy away from the market during times like this. When you look at the returns after a 20% or more pullback in the market, they are positive 77% of the time. I mean, even during bull markets, stock market corrections happen, and they happen almost every single year. Most people are dollar cost averaging into their retirement accounts, and they take advantage of those times. The problem is that those corrections during those bull markets are typically pretty brief, which was the case in 2020 and 2018. But when you have a longer, more drawn out bear market, you're able to capture more of your savings at lower asset values. And as things return over time, it can really help with compounding the growth. Now, it's not easy to work hard, put your money away in your 401k or other savings account, and watch it go down because of the market. But it's important to realize that market swings happen over time, and trying to time the market can actually lead to underperformance over a long period of time. In fact, JP Morgan looked at how the average investor fared from 2002 through 2021. And as you could see, the average investor underperformed almost every asset class. Now, why is that? That's because the average investor tends to chase momentum. They get out of things that are underperforming before they recover and into things that are doing well before they pull back. That's why it is important to not deviate from your long-term savings and investing plan during times like this. In fact, that brings me to the third reason why I'm optimistic about the future of retirement. Next year, you could save even more into your retirement accounts. The IRS raised the contribution limits by almost 10% for 2023, which means that even if you're getting a late start to saving for retirement, you can now put more money away than ever before, all while asset prices are lower. Every year, I talk to hundreds of people who are planning for retirement. And for some, life just got in the way when they were younger and they weren't able to save like they wanted to. That doesn't mean that retirement isn't going to be possible. It's just going to take a lot of discipline to save aggressively. In fact, if you are 50 and haven't even started saving yet, in 2023, you'll be able to contribute $30,000 to your 401k. Now, if you max that out from when you're 50 to when you're 65 years old, and you were able to get an average of a 7% rate of return, you would have over $750,000 by the time you are 65. And this doesn't include any company match or additional savings in other accounts. So just because you got a late start doesn't mean that retirement isn't possible. If you feel like the last year has gotten you off track to your retirement goals, or you just have no clue where you stand, use the link in the description to schedule some time with our team where we will help you build out a detailed retirement analysis at no cost whatsoever. And also make sure that you subscribe to the channel so you don't miss any of our weekly retirement videos or episodes of a retirement podcast called The Retire Once Show. So to recap, the 3 reasons why I'm optimistic about the future retirement. Number 1, you can now get yield in your investment portfolio without having to take additional risk in changing your asset allocation. Number 2, the market sell-off provides a better long-term buying opportunity for those that are saving for retirement. And number 3, you'll be able to save even more than ever before in your retirement accounts. Hopefully you're on your way to a successful retirement. Now just make sure you avoid any major mistakes along the way. Now to help you do that, make sure you check out this video where I talk about the 5 worst things you could do after you retire. I'll see you there.